Okay. Happy New Year. We hope you all had a safe and joyous and prosperous holiday season, despite a very difficult and challenging year for all of us. And we want to appreciate you for taking time from your busy schedule to participate in our 4Q webcast. We have an agenda for today's meeting. We're always going to try to keep these webcasts 30 minutes. And always, this will be recorded. And later this afternoon, we'll actually send links. So some of the visuals or whatever, you'll be able to go back and listen and see the visuals combined. So next slide. So this is the visual, or this is the agenda that we put together for today. I'm going to start by providing a firm update, and then I'm going to turn over the presentation to Nick and Matt, who will go through the 4Q market review and then a 2021 global market update. And then I'm going to come back at the very end to talk about some of the new initiatives that we've been working on at the firm in terms of investment policy, asset allocation updates. So we're going to start with a quick firm update. So we're going to start with last year. 2020 was a very rewarding year for our firm, despite a very challenging environment for many companies and many individuals. One of the key initiatives of our firm last year was to strengthen the team and deepen the bench of the team. And so many of you have had a chance to meet Nick Botticelli either in person or on the various Zooms we've had. Nick joined us as the Chief Investment Strategist on September 1st. He came to us with almost 25 years of experience managing large and complex fiduciary portfolios at two of the nation's largest, kind of most respected corporate plans. He also spent several years in the outsourced chief investment officer business. So we were thrilled to welcome Nick to the team. 2020 was a fantastic year for our firm, and we are very proud of the growth that we accomplished. So year over year, our assets and revenue nearly doubled as we welcomed a significant number of new client relationships throughout the calendar year. 2021 has been off to an amazing start. So as we sit here today, we now directly supervise a little bit more than 800 million of assets. And we feel very strongly that we'll be at the $1 billion mark in the very near term. So really a fantastic year for the firm. We're very financially strong, which has allowed us to really pursue now a lot of our 2021 initiatives. The first one is some new technology enhancements. We tend to pursue and implement a new full-time trading and portfolio management system. We've had one in place for 3 years, but given the growth of the business and the complexity of the client relationships we're dealing with, we feel like we need a more enhanced trading and portfolio management system. So that will be a 1Q initiative, and we hope to have that fully implemented by this summer. As part of that same package is expanding our client information portal. You can go online now and see our research reports, but we really want to have an integrated, centralized portal where you'll be able to get your statements and your quarterly reviews and all of our commentaries and past webcasts. And so that's a big initiative. So some of the software programs that we're evaluating have those two capabilities integrated. And then right now we've invested heavily in our technology. As you know, we really believe in open source fintech to support our key team members. But there are some additional investment modeling and risk management systems that we're evaluating, and we expect to have all of those completed within this coming calendar year. And then on the personnel priorities front, many of you know and work directly with Dan Chesson. We're going to add another member of the team to work directly with Dan in our operations group. We also plan to start our growth initiatives. The firm recently reviewed a 5-year strategic plan, and that really calls us for growing significantly across the entire country. And to lead that, we need more individuals to help us identify candidates for our firm. So we plan to hire at least one investment officer to help us grow our business. And then one of our plans last summer that unfortunately we couldn't execute because of COVID was to have a formal internship program. As many of you know, we're located here in Scottsdale, Arizona State's about 15 minutes from our campus. So in 2021, health permitting, we really hope to have a formalized summer internship program, which will allow us to bring some young people into the firm and then allow us to really see their capabilities and hopefully use them in the future as new employees. So we have a lot of exciting things going on at the firm, and we had a great 2020. So with that, I'm going to turn over the portfolio to Nick and Matt, who are going to do now a review.
Thank you, Kurt. I divided the summary of the quarter into two categories. On the left side, macro environment events. On the right side, the public market outcomes. So if we focus on the left side first, COVID-19 obviously occupied headlines for the majority of 2020. In the fourth quarter, that news was mostly positive from the extent of strong vaccine trial results by Pfizer and Moderna, and subsequent approvals of the vaccines by the FDA, which helped to boost markets. The Federal Reserve, who initially responded very strongly in March when the market started to sell off by implementing a $700 billion quantitative easing program and lowering the federal funds rate, recommitted to using its full suite of tools here in December of 2020. So expected to have Fed support for the near to midterm future at the very least. And then the US dollar continued to underperform foreign currencies and the employment rate continued to improve. On the public market side, global equities had one of its best quarters ever. And we had a slight rotation. So the indices that were lagging growth, which had led the markets in the second quarter and third quarter, those indices started to outpace the rest of the economy. In alternatives, commodity stocks had their best quarter in a very long time, erasing negative year-to-date returns. And fixed income had low but positive returns, improving already positive year-to-date returns. On slide 7, this is, I think, a familiar chart for most people, but this is our global index performance, and we also added some key indicators to the bottom of the page. On this slide, I'm going to cover kind of what's in the red box here, and these are the Q4 2020 returns for some equity indices and also an alternative indice. So we talked earlier a little bit about the rotation. You'll see the best performer in the fourth quarter was the US small cap market, the Russell 2000. Slightly behind that were non-US equities. So both emerging market equities and developed international equities both had very strong quarters. And in alternatives, commodities had a very tough time most of the year. They were negative coming into the fourth quarter. They rallied strongly over 20% to kind of erase their negative performance for the year and end up right around neutral. And then two indicators I'll mention on this page, looking down the bottom of the page. One is the 10-year Treasury bond, ended the year slightly below 1% at 0.9%. This is about 1% lower than it was at the end of 2019, when it was 1.9%. And then, as I mentioned, the Fed's fund rate was lowered down to 0.25. This is the lowest the Fed's fund rate has been going back to 2015. On slide 8, we look at the kind of the two biggest parts of all our client portfolios, global equities and fixed income. And the story of the quarter changed from October through the last 2 months of the quarter, but the markets rallied early in the quarter, coming off a big sell-off in September. But then the kind of COVID story started to pick up from a negative standpoint. Cases started to surge again. Markets sold off and were actually negative at the end of October. From that point forward, we had the election, we had the positive news on the vaccine, and markets rose all the way to almost 15%. Global equities almost 15% for the quarter. That ended, so they ended the quarter about 15 percentage points, 14 percentage points higher than US fixed income, a large outperformance for global equities. On slide 9, I really want to focus on this for about a minute, but this rotation is something we were talking about a lot to our clients in fourth quarter reviews. At the end of the third quarter, US growth stocks had driven the markets. They were really the only thing that were positive when you looked at all the major indices. And that performance was really driven by only 10 names. So we were getting a little bit concerned about the frothiness of those 10 names. What we saw here in the fourth quarter was a rotation. US small cap came and beat US large cap, which it hadn't done for a bit of time. Value beat growth stocks by about 5%, and non-US beat US markets. So we had this rotation of things that were leading, still did well, but the things that were lagging outpaced the other indices. And then looking at fixed income markets, again, for the most part, a positive story for investment grade and non-investment grade credit over the quarter. We had a large sell-off in March that made spreads blow out. Spreads are a measure of risk and potential return for fixed income indices. Those came all the way back. High yield ended the quarter up 5.8%, which actually propelled it to be the best fixed income major asset class for the year, as it then outpaced munis and US core. Munis and US core still provided positive returns, and US governments due to rising interest rates ended up with the negative return for the quarter.
So during the proliferation of the pandemic, cash levels on corporate balance sheets exploded to all-time highs. That's with over $2 trillion of investment grade and high yield bonds being issued year to date through the end of November. With cheap borrowing available, corporations were able to maintain dividend payments and build a liquidity buffer during the economic downturn. This cash that's sort of sitting on their balance sheets is waiting for redeployment, and we consider it sort of a pent-up demand. So potentially funding shareholder-friendly activities such as resuming share buybacks, paying down debt, or funding merger and acquisition activity in the coming year. All of these could be a tailwind for risk assets once injected back into the market. But for the time being, sort of acting as a partial hedge against prolonged surge of infections that could slow down the economic recovery. So we'll go to the next slide here. And another key relationship we saw buck its recent trend was the US dollar. The dollar had previously had a decade of almost uninterrupted gains. However, with global growth outside the US looking stronger, recovering from lower lows, and fiscal and monetary intervention here in the US driving real rates lower, the pieces are in place to see a retracing of some of those previous gains over the last 10 years. This would actually provide support to non-US dollar denominated assets on a relative basis, such as international equities and debt. Now, let's zoom out to the year as a whole. So looking back on 2020, it was an extremely volatile year. I've got some stats here. There were 44 trading days where the S&P was up or down over 2% in either direction, and 14 days where the returns were plus or minus 4% in a day. March 16th of 2020's negative 11.98% drop was the largest since Black Monday, October 19th, 1987. However, in spite of all this volatility, 2020 was a banner year for risk assets. Investors who were diligent, rebalanced their exposures during the drawdown, and held diversified allocations ended up with strong double-digit returns. Investors who didn't have a plan likely took risk off the table at the wrong time and missed global equities' 70+% rally off the bottom. Having a systematic plan in place and how to implement your portfolio is key to weathering these volatile markets like we had in 2020. And now we get the opportunity with this in the rearview mirror to look forward at what we're expecting in 2021 and beyond.
Thank you, Matt. On slide 15, we have our current capital market assumptions. I'm going to spend a couple minutes on this slide because it's an important one of the more important slides in the presentation deck. The information on this slide shows expected returns over the next 5+ years, and it's an aggregation of both our internal work to come up with expected returns, plus we also aggregate some of our strategic partners' expected returns. This way, by combining all those different views together, we kind of remove any single bias from the expected returns as we look at the market as a whole. The chart is separated into 3 sections. On the far left, we have our bond indices. In the middle are public equities, and on the right side are private equities. You'll notice that the public equity returns, lowest numbers on the page, which is usually the case. I think that the thing that's different now is that these numbers are significantly lower than what we would have expected over the last several years, prior decades. These numbers have come down significantly as bonds have had a significant rally over the last 20+ years. In the middle of the page, we look at our global equities. US markets have driven all global equities since the global financial crisis in 2008, 2009. That's left them with high valuations and lower expected returns going forward, about sub 5%. Looking outside the US at non-US equities, both international and emerging markets, by investing in those asset classes or shifting some assets, some of the portfolio assets into those asset classes, you can expect a pickup of about 2% per year over the long term. And then kind of the highest numbers on the page, again, not a surprise, but kind of relatively bigger than they have been in the past versus the public market indices are our private market. We look at private markets in 3 different buckets: real assets, which include things like real estate, private credit, and private equity. All these returns are the highest ones on the page, and we think it's prudent for investors to consider an increased allocation to these assets as we look at the return landscape. Moving on to slide 16 and looking at the global yields. We kept this chart in the same format, but one component of return is yields. And a lot of our clients, both on the high net worth side and both on the institution side that have spending plans, rely on yields, income in the portfolio to help meet their obligations. The story here is similar to the return story. Yields are lower than they have been going forward, and they're not going to be able to contribute the same amount of income when you just look at the public fixed income, the public fixed income part of the equation. Something else unique on this slide is we look at the equities. For the most part, equity expected dividends are higher than traditional investment grade fixed income. This has happened in the past, but is pretty unique. Traditionally, we would expect public fixed income to have higher yields than what you can get in public equity. So right now, sitting in public equities, you're going to earn more income than you will in your fixed income portfolios. Again, I think the story on this slide is look at the private markets, specifically private real assets and private credit. These tend to be asset classes where, especially the way we look to implement them, come with attractive yields, much more attractive than what you're going to get in the public markets. Another slide that I'm going to spend some time on here is one of our very important models. Up to this point, we kind of looked at an aggregation of expected returns, but now we're going to look at our specific work and how we look at the markets. One of our most important models is U.S. equity risk premium. This looks at the relative expected return of U.S. equities. So in this case, we're using the S&P 500, so U.S. large caps, relative to what we call the risk-free rate. And in this case, we're using the 10-year Treasury bond. The chart on the top left tracks that relationship going back over the last 25 years, basically back to the end of 1994. And if you just look at the jagged line, you'll see at times bonds have been more attractive and stocks have been more attractive. You can use that solid blue line that goes across the page to kind of differentiate between when stocks are attractive and when bonds are attractive. To help kind of clarify what this chart is saying, I kind of called out a couple different spots. The first one I'll focus on is on the left side of the page where the red circle is. As most of you remember, the tech bubble met with large equity returns. A lot of them in corporations that ended up not existing a few years later. At that point, stocks had rallied so much and valuations had gone so high that the expected return for stocks were very low. At the time, bond yields and bond expected returns are actually higher than stocks. So at that point in time, our model would have told you to shift some assets from stocks into bonds. Looking at kind of the flip side of that equation, if you look at where the yellow circle is on that top chart, this is the global financial crisis. As you remember, stocks sold off tremendously during the credit crisis of 2008, 2009. But right around March 2009, near the bottom, this signal got to its most extreme. And what I mean by extreme is +3 standard deviations. So we break our models into standard deviations from 1, 2, and 3. If something is +3 or -3, that is extreme. You really can't ignore it. +2 or -2, still very strong. When we get kind of closer to 0 or the average, the signals are not as strong, and we're not willing to take as much risk to over allocate to those asset classes. But as we know, in back to the global financial crisis in 2009, a really attractive time to invest in stocks. And I think we kind of know what happened from that point forward with stocks. They rallied tremendously. But we're going to actually talk about that specific outperformance when we look at the table here on the bottom right of this page. So this table is broken into rows that correspond to those standard deviation levels. So the top line in the table is most attractive for stocks. The bottom line in the table is the least attractive for stocks, attractive for bonds. So if we look at that top line where I have the yellow circle next to it, this is this environment was the global financial crisis. We had 3 standard deviations of cheapness, so attractiveness for stocks. And if you had invested in stocks at this point in time, you would have realized about 13% average return per year over the next 10 years, significant outperformance. If we go down 2 lines where I have the blue star, this is kind of where we are today. We're at the very low end of the +1 to +2 standard deviations. We're very close to kind of that +1 standard deviation. This has happened more frequently when you look at the data going back in 25 years. And even in these scenarios, by shifting some assets to stocks from bonds, you will receive excess return on scale of about 8% on average per year for 10 years. And then going down to the bottom to a scenario where bonds were attractive, again, corresponding to that tech bubble, when bonds are very attractive. If you shift assets from stocks to bonds in those scenarios, over history, this 25-year history, you would have outperformed, your bonds would outperform their stocks by about 3% on average per year over the next 10 years. So this is, like I said, this is an important model we use in determining shifting assets between stocks and bonds.
Zooming out to focus just on the equity component of that equation, we'll see that valuations have diverged significantly since the global financial crisis. So with the US becoming relatively more expensive than both non-US developed and emerging markets. So valuations, which is basically the price we pay for corporate fundamental assets, is closely related to forward-looking return expectations for equities. So the pricier valuations here in the US help explain a significant portion of why the lower return expectations show for US equities in our models. As we can see, these US valuation levels in the chart were last seen in 2001 during the drawdowns just after the peak of the tech bubble. So, the relative performance opportunity on a forward-looking basis, definitely tilts more towards the international markets. So on the next slide, in addition to valuations driving returns, US-based investors should pay attention to US dollar strength and weakness. So as I stated earlier, the US dollar had a significant run over the last decade, but increasing levels of stimulus, increased government borrowing and deficit spending, and then also the recovering growth rates overseas have set the stage for a reversion of the US dollar from previous highs. So this serves as a benefit to investors who diversify internationally as the dollar weakens versus international currencies, and it can actually provide an additional source of relative return for international market exposures. As we look in the rearview mirror, that same relationship held and was actually a detriment to international equity returns. That's part of the reason why the US actually benefited from the strengthening dollar over the last decade. So on the next slide, switching gears to fixed income, we look at the option adjusted spreads of credit sensitive bonds in the investment grade segment on the bottom, and then the high yield market on the top. So this is basically the extra yield a bond gives over the maturity matched risk-free rate of US Treasuries. So this is essentially the payment for credit risk in each of these universes. So during the pandemic, during the market drawdown, let's say, the spread in high yield bonds jumped out to shy of just 11%. So this was more than a 2 standard deviation jump that indicated we should allocate into the high yield space. So we did towards the end of March. And through the end of the year, that high yield exposure outperformed the Barclays US aggregate by around 15 percentage points as the spreads compressed back to the pre-crisis levels. So, definitely taking these statistical models into account, gives us the opportunities where the odds are in our favor to generate excess returns relative to the benchmark universe. So taking a few minutes to sort of now look at sort of the macro backdrop, focus on some important indicators that the Fed watches, we can easily see the impact of the COVID-19 pandemic here and the lockdowns that ensued. So unemployment spiked and has been coming down to the current level. However, it's still almost double the pre-crisis levels. Historically, spikes in unemployment make 60 to 75% of their recovery to what they call full employment within 6 to 15 months. The remaining amount can usually take a couple of years or more to remove the slack from the labor market. So if unemployment remains elevated, rates are likely to stay low. Now, going to another key Fed indicator that sort of informs the guidance on rates is the PCE deflator, or the personal consumption expenditure deflator. So it's an inflation estimate that's watched closely by the Fed. One thing that we notice is that in spite of all this record stimulus, up to and including stimulus checks going directly to consumers, we're still seeing difficulty in inflation hitting that 2% target and staying above it for any period of time. So consumer saving rates has actually jumped during the pandemic, and what we call the velocity of money, or how many times a dollar is recycled through the economy, has actually slowed. In addition, the disinflationary impacts of technology innovation are an ongoing consideration as to why it's been difficult to drive healthy levels of inflation into the markets. So low inflation indicates the economy isn't overheating, and therefore the Fed is more likely to keep rates low with low inflation.
So to wrap up 2020, we look at reasons for optimism and reasons for pessimism. And as usual with some of these factors, they can be on both sides of the line, right? There's expectations. If those expectations don't play out, they end up flipping from optimism to pessimism. So we think, the biggest factor this year is going to be, again, COVID-19, the vaccine distribution success. If we're able to distribute it to the majority of Americans, if the uptake is high, it helps fight off the virus. That should be positive for markets. That's going to help businesses reopen. That's going to help people go back to work. It's going to help, as Matt mentioned, the velocity of money being spent again in the economy. The Fed, again, in December came out and made their stance very well known. They're going to be accommodative to the economy until we reach those key metrics that Matt mentioned. The expectation is for this to last several years. As long as that does, again, it's going to be optimistic. If the market really here takes off here in the short term and the Fed kind of pulls forward their change in policy, that will be seen as a negative to the markets. With the change in political leadership, we should see additional stimulus to individuals, but also to municipalities. There's a lot of municipalities that have been hurt significantly because of the economic shutdown or slowdown that took place in those areas. When this stimulus that's expected to come through takes place, it should help to support those municipal bonds. On the flip side, we look at the U.S. equity valuations and they're stretched. Again, it doesn't necessarily predict negative returns or a big correction, but it does predict that over the next 10 years, we're just going to have lower returns than we have over the previous 10 or 20 years. With higher valuations, we also tend to expect some higher volatility, which again, we'll take advantage of in portfolios should that happen. Fixed income expected returns are expected to be lower than averages. And again, to combat these market low returns, both in US equities and fixed income, we're looking to implement additional private market investments for clients, which we will believe will help boost returns and yields. Now I'm going to turn it back over to Kurt to talk about our last topic.
Okay, thanks, Nick. Thanks, Matt. Initiative that we've been working on here at the firm is relates to the investment policies and our strategies. And so as we just talked about, and we've been going through this with many of you for our quarterly reviews, public market returns from traditional stocks and bonds are likely to be significantly lower than they've been the last 10 years and over history. And so one of the goals that we've been working on is how do we increase cash flow yields and total returns, given such low expected results out of traditional public securities. And so where appropriate for clients based on your individual fact pattern, our decision has been to shift some of the allocation in these traditional fixed income and equity strategies into private markets. And that has been implemented across some of our client portfolios based on their specific needs and goals and objectives. So the methodology is at the bottom. We are sourcing the private equity from public equity. So this would be venture capital, growth equity, buyout strategies. We are going to be sourcing the private credit and have sourced the private credit from traditional fixed income. So as we talked about the cash yields here being in the high single digits versus low single digits. So this would increase the cash flow and the expected return from the bond portion. And then finally, the private real assets. And many of you on this webcast today participated in the recent Blackstone BREIT strategy that we executed at the very end of December. And given the unique features of that portfolio, we opted to source that 70% from traditional fixed income and 30% from equities. So going forward, we are going to continue to look at new and exciting strategies to help the portfolio returns. So in the first quarter, as we conduct our year-end reviews, we're going to be coming to all of the clients and repapering basically the investment policy statements with a new investment plan, which is the last page. So this is just an illustrative example. Once again, this is going to be customized to each client. We know not everyone is able or wants to pursue in the private equity strategies, the private strategies, but our thinking here today is we'll now create a new 3-bucket strategy from more of a traditional 2-bucket strategy. So we'll now have traditional total public fixed income. So these are all publicly traded strategies. So that'll be cash, core bonds, which will be municipal bonds for the high net worth clients, investment grade corporate and government bonds for our fiduciary clients, and then opportunistic, which as Matt mentioned earlier, we implemented a high yield allocation for client accounts in March. And then public equity will be US, non-US developed and non-US emerging, once again executed predominantly through low fee ETFs. And then the three buckets on the bottom, the private credit, the private equity, and the private real assets. And so our intent is to move approximately 20% of our client portfolios into those categories. As noted on the right, it will not change the overall equity fixed income structure. So we're not proposing that clients go from 60% in equities to 80%. In fact, the reconstitution using these private strategies will remain the same for your equity fixed income distribution. It's just changing the components of it. And once again, we know this doesn't apply in every situation. And that's why we'll be meeting with each client to talk about how these could be applied in your portfolio. So because we want to be sensitive to people's time today, we're actually going to host a special webcast on the 26th of this month. Once again, it'll be a target for 30 minutes. We have two new private investment strategies that our firm has been evaluating. Our internal investment policy group has approved both of them. And so Nick and Matt are going to do a special webcast. We'll send out a separate invitation tomorrow for the 26th. It'll be at the same time, 10 a.m. Mountain Time, 9 a.m. Pacific, 11 a.m. Central, and 12 noon East Coast. So our goal is to kind of have a webcast, hopefully once a month on a new specialized topic, and then just our normal quarterly webcast. So this will be coming up. Once again, you'll receive a copy of the invitation tomorrow for that. So that kind of concludes our comments today. Once again, we appreciate the trust and confidence in our organization. We all hope that we can get back on the road and see people face to face, but the fourth quarter reviews, obviously a lot of them will be done via Zoom. But we're excited about the growth of our firm and all initiatives we're working on. And once again, have a great new year, and we'll look forward to hopefully seeing many of you in person this year. Thanks again for your time today.